In this video, we'll discuss return on capital employed. What is the definition of a return on capital employed? The definition is basically how effectively capital employed is being used by the company. In other words, we can say how well the company is generating profit from its capital employed. The formula to calculate the return on capital employed is profit before interest and tax divided by capital employed into the 100. It may be profit before interest and tax divided by average capital employed, because if the data is available to calculate the average capital, then definitely we will use the average capital employed. While calculating the profit before interest and tax, we need to adjust the exceptional and extraordinary items. Capital employed is equal to equity plus long-term debts. In other words, we can say total assets less current liabilities at the beginning of the period. This is very important. So average capital employed is equal to opening capital employed plus closing capital employed divided by 2. So what are the positives of this method? The biggest positives are this is simple and easy to calculate. The negatives are it based upon the book value of the capital employed. It doesn't consider the time value of cash flows. Third, it based upon the non-cash items like depreciation, amortization. So these are the negatives of return on capital employed. What is this application? It can be used for the performance assessment, or it can be used for appraising the project. Like this is assessing the project application, this is appraising the project. So we can compare the return on capital employed with the own historical return on capital employed. We can compare the return on capital employed with the competitor's return on capital employed. We can compare our return on capital with the industry return on capital. Then based upon this, we can assess the performance. So based upon these results, we will be able to know how effectively we have utilized the capital and how effectively my competitor and the industry has utilized the capital. In the same way, return on capital employed can be used to appraise the project if the return on capital is itself a return. Cost is in the form of weighted average cost of capital. This is in percentage. This will also be in percentage, apple to apple comparison. So if the return on capital employed, which is a return, is greater than weighted average cost of capital, then accept the project. If the return on capital is equal to weighted average cost of capital, still accept the project, because you will have learning, you will have some sort of goodwill into the market. If the return on capital employed is lesser than the WACC, or WACC is greater than the return on capital, then don't accept the project. So this is the application of return on capital employed. This is an example. Just see, this is my equity portion. This is my debt portion. This is at the beginning of the year. This is equity. This is debt at the end of the year. This total is called my capital employed. We have discussed already equity plus long-term debts is equal to capital employed. So profit before tax is 210,000. Income tax expense is 65,000. Interest charges on the bank loan is 30,000. Calculate the return on capital employed. We know the formula is profit before interest and tax divided by average capital employed into 100. So profit before, this is profit before tax. It means interest has been deducted out of this profit 210,000. If we need to add back this 30,000, so it will become profit before interest and tax. So let's calculate it. Return on capital employed is equal to profit before interest and tax divided by average capital employed into 100. Profit before interest and tax is 210,000 plus this 30,000. So total 240,000. Average capital employed is equal to 1 million plus 1.4 million divided by 1.2 million. Return on capital employed is 240,000 profit before interest and tax divided by 1.2 million. Average capital employed into 100. This is 20% is my return on capital. So we will compare this 20% with the historical results, competitor return on capital employed, and industry return on capital employed to assess the performance of the company. Then we will compare it with the WACC to assess the project. If WACC is more than 20%, then reject the project, otherwise accept it. This is return on capital employed. And the most important thing is These are the risky area. You need to be very careful. There are chances that you will make an error. Might be you will use profit before tax or profit after tax, but we have discussed we need to use profit before interest and tax. Might be exceptional items will not be adjusted. Suppose profit before interest and tax is carrying exceptional items or extraordinary items, might be you will not adjust it. This is the chances of error over here as well. And third thing is, might be market value of capital employed will be used instead of the book value. These are the risky areas. You need to be very careful while applying the return on capital employed. Thank you very much for joining us.